Hello, everybody, and welcome to another DeFi Ask Me Anything episode with BraveNewDeFi. Brave is head of risk and product at Nexus Mutual, and he will take the last three or four questions on the forum, which you can find if you could go to the search function at the top right and type in DeFi AMA. These are the questions that we received for our first DeFi and Risk Learning Group cohort. The participants had some really interesting questions about cryptography, insurance, risk, and DeFi, and our risk experts are tackling them. Okay, welcome, Brave. Anything before we start?
No, I think let's jump into the questions.
Let's do that. We had answered part of these questions with Hugh at the first episode of the DeFi AMA, and I will share them again, time-stamped for the DRLG participants on the forum. And yeah, Brave is tackling the rest of them before I do. Okay, let's continue with gjohnston's very insightful, interesting question that also touches his personal experience as an underwriter. I think it's fair to sum up part of his questions in three bullet points. And I feel like one of the first questions he basically had is, where do cryptography, insurance, and risk intersect?
Yeah, well, on this, cryptography is just a form of encryption, and cryptography is at the heart of blockchain technology. So when the Bitcoin and Ethereum networks first launched, they opened up a wave of innovation, but over time, we also realized that blockchain technology introduces new kinds of risks as well. So blockchain technology itself is just another piece of technology that we can use within the insurance world. And there's also new risks that this technology brings. So if we can look at things like private key loss, whether that's somebody losing access to their private keys or through common Web 2 attack vectors like phishing and social engineering, hacks and exploits in DeFi, and a variety of others. So there are new risks that come with these new technologies, and people want to protect themselves against this. Um, this is no different than when computers and the internet came out, and then over time, there were new kinds of risks that people were facing, and so that's why we see seen such an increase in demand for things like cybersecurity insurance products in the last 20 years, because computers have become such a cornerstone of everyday life. The risk of being locked out of your computer or having your business information stolen are that much more severe. So personally, I see blockchain risk as another variation on this trend. There's new risks that people want to protect themselves against, and in order to participate or interact with this technology, they need to have some kind of protection. My experience at Nexus, we know that funds, institutions, retail users, and high net worth individuals, any of these folks, a lot of times as a prerequisite, they need to have coverage if they're deploying funds on chain. So this for them is necessary if they want to participate in the on-chain economy. So I think as we see blockchain technology and the applications built on top of blockchains advance, there's going to be a greater need for different kinds of insurance. And we're also going to see more insurance companies looking to leverage the benefits that blockchains bring, like automation and improved efficiency. So that in my view is kind of where cryptography, insurance, and risk all meet together.
Thanks, Brave. I am very excited about how this field will develop, and I think G. Johnston is as well. He's asking, will some legacy insurance become obsolete with layer ones or layer twos? What do you think, Brave?
My answer here is I think there's potential for blockchain technology to reduce the cost of some forms of insurance, like title insurance. But I don't believe it's going to become obsolete as long as humans are involved in managing the underlying data that backs on-chain records. People often talk about, you can tokenize everything. You could tokenize the deed for your house. You can tokenize it, but there's still something that represents it in the real world. Even if this was all just data on a computer, there still is at some, in one way or another, there is some room for human error involved. So there's always going to be need for some kind of insurance. However, I do think that you can reduce the cost and improve efficiency using blockchain technology. Um, so, in the example of title insurance, I know a lot of people see title insurance as a scam, but I live in a rural area and I know that title insurance has saved more than a few people when they did a land sale where they didn't actually have the rights to all of the land they purchased and they were able to claim on that insurance and they weren't impacted by it. There was one larger scale deal where I live where a large company, a large mining company, bought some land and they figured out they didn't own part of it and they didn't have the necessary title insurance and they lost about $10 million. So it can have an impact there. But again, you can reduce the cost of title insurance, um, and you can make things a lot more efficient by putting things on chain. So if you were to put this information on chain and create a better system where that information can't be lost, and you can really meaningfully reduce the cost of that kind of insurance, title insurance, and other lines of business. So the biggest benefits I see are reductions in cost due to higher levels of efficiency. I think there are other types of insurance that can be offered, but again, you can never reduce risk to zero. So I don't think blockchain technology is going to reduce any risk out there to an absolute zero where people don't want to have some kind of coverage for it. But again, I think that we can improve efficiency a lot and bring down the cost of coverage over time.
Thanks, Brave. Related to that, how might decentralized capital pools like Nexus transform risk management and make the field more efficient?
Yeah, I think capital coordination is the biggest way. And again, this comes down to efficiency. So capital coordination in traditional markets takes a while. And a lot of this is due to the business and legal requirements that need to be approved before a deal can move forward. You're still going to have that to a certain degree, but if companies were able to support, source capacity from decentralized underwriting pools, or even permissioned underwriting pools that are on chain, and they can come to an agreement on business terms, they could bring deals to market with greater speed than they currently do. They would need to still have some of those legal agreements in place, but if they could pare back the need for some of the terms in the legal proceedings or the legal agreements, you could automate a lot of that with smart contracts, where somebody can't take money out under certain conditions, and that could improve. It could improve the way that people can bring deals to market. So again, speed and efficiency here, and that's where I see the most potential for growth in traditional insurance. From what we're looking at on chain, so far with Nexus, we're not seeing people open sourcing their underwriting models because there's really no benefit to. In a lot of other places, a lot of other protocols, we see people open source the code, but some of the data sets they're using, they're not open sourcing those because that's kind of proprietary information. If every underwriter open sourced their underwriting methodology, it would kind of be a race to zero, and it'd be very hard to compete with one another. But I do think that using pricing in different pools um, is kind of a standard because right now anybody can come and look at the pricing on Nexus, but I can't say go and look at the pricing in some traditional markets unless I'm privy to that information or I have access to that information somewhere. So I think there's going to be a bigger push in transparency so people can understand what the risk is, what pricing looks like, and over time, I think we can improve transparency for both underwriters and for people that are looking to buy coverage.
Thanks, Brave. Also, thanks, gjohnston, for sharing highlights from your personal experience as an underwriter, as someone who works closely to our space. And we're looking forward to how you'll find Nexus Mutual and the architecture, which I think is quite amazing. Moving on to Sleep on It's interesting questions. The first one is a bit more on the quantum resistant algorithms type um, advanced topics, which anyone seeing this who is an expert in these areas are welcome to respond to on our forum. Would love to have experts discuss, but we're gonna go over the rest of them with Brave here as well. So the first question Sleep On It has for Brave at the moment is people risk how to ensure users without full KYC using ZK proofs.
So the biggest hurdle here is this needs to be cleared with regulators. So technically, you could do this today. You can use ZK proofs to prove someone's identity without requiring full KYC. But regulators don't see that as valid. So to stay compliant, companies that require KYC need to maintain certain records to adhere to, United States, European Union, and other nations where they have regulations, and that all depends on which jurisdiction that you're operating in. So the innovation here needs really to happen with regulators, not so much the tech that we have, because that tech is available. However, there are some providers like SumSub, which is one of the KYC providers out there, and they have optionality to allow users to KYC on SubSum's platform. So let's say that you did this, you onboarded to SumSub through Coinbase, and then you went somewhere else that also uses SumSub. As long as that provider, for example, the mutual uses SumSub, um, we have the option where if you've already KYC'd with them, you don't need to KYC with us. They can use those records to make you compliant. So there are some things like that, but until we can get to using ZK proofs to prove somebody's identity without actually exposing that information, that needs to be something that's accepted by regulators. And I still think we're a little ways away off from that at this point in time.
Before we move on to Sleep On Its next question, I also want to highlight and ask Brave about what he thinks about social engineering types of risks, which are really hard to protect, but we've had our fair share of experiences, both in terms of our own and mutual members coming to us. Brave, any words on how to protect against social engineering type of risks?
Yeah, be skeptical. When something sounds too good to be true, it usually is. So what I'll say is if you're not expecting an email from somebody, if you're not expecting a DM from somebody, and they send you something and there's some offer where they want you to click on something or test some game or do something, it's likely going to be a scam. Social engineering is really hard. It's hard to cover because people can game that. How do I actually prove that somebody was socially engineered and that they didn't create a social engineering scam and then sent themselves from a different account a message and then clicked on it and then lost their money when really they still have access to that money? So most of the things that we can't cover because we either can't prove that we can't prove whether or not a claim is valid or if it's fraudulent, or in cases like social engineering, which is a little bit of the first one. But the second one is even if we could, the cost for that coverage would be incredibly high, and nobody would want to pay that. But because social engineering is so prevalent and there's many different ways to do it, the best thing you can do, especially if you're in crypto, is for your wallet, use something like I use Ravi Wallet, which has kind of a built-in scam detector in there. So it'll give you a message like this looks like a malicious transaction, do not approve this. There are other tooling out there for like MetaMask and some other wallets like Wallet Guard, Pocket Universe. So there is a lot of tooling out there to prevent you from giving an approval to somebody through your crypto wallet. Um, but for a lot of things, just kind of be vigilant, read a little bit about OPSEC, and if somebody is sending you a message and you're not expecting it, just be cautious. And I always tell people not to download PDFs. If you do, to put it into Google Drive before accessing it. Don't open it up on your computer in Adobe or something like that, because somebody can hide malicious code inside of a PDF that can be executed if you open it directly on your computer without putting it into something like Google Drive. So that's my approach there. I don't have a more comprehensive answer than that, but it's just be careful and be vigilant.
That's a great tip. Thanks, Brave. Also, thanks, Sleep on It. It's always nice to have your interesting questions. Oh, sorry, I forgot the last one. Before thanking both of you. Okay, it's actually one of the best questions in my view, in terms of my own personal interests. Simplicity. Can users get on-chain insurance without realizing it? I think we do have some cases that we can talk about here. Yeah, Brave, what do you think?
Yeah, they can. This is largely up to teams that want to incorporate coverage into their product offering. So there are people that can do this. We offer native protocol cover for some teams. So they're offering a certain level of coverage by default. So you can be using a protocol. For example, we work with one of the teams that's running like a BitTensor subnet, and they buy $25 million in blanket coverage for their users. So if there's some kind of loss, people that are delegating to the validators on that subnet can be reimbursed from that $25 million policy. So we do have examples like that, and people that are providing essentially what is like an FDIC type product where people are covered up to a certain amount. But again, this is largely up to teams that offer this. So what you're doing is you're abstracting away buying cover from the end user to somebody on the team buying it on behalf of users. So we have seen people do this. I would love to see more people do this to protect their users by a certain like default level. Again, like FDIC style coverage. But I think as time goes on, we'll see more teams looking into that as well. But yeah, this also just comes down to teams that are building and the UX they want to provide for their users. So we're always happy to work with folks that are interested in doing this.
Okay. Again, thank you, Sleep on It, and thank you, Brave. I just wanted to note the website, nexusmutual.io/contact is the best way to reach our BD and product teams. Okay, moving on to the next question. It comes from Elliot. How can DeFi make insurance/risk products more transparent and capital efficient?
Yeah, so on the transparency side, using Nexus Mutual as an example, all of our cover wordings are on chain. All of our annex documents are on chain on on IPFS. Um, all of the data that you could want to know about the mutual is available on chain, and we host that on our Dune dashboards where we aggregate that data so it's easy for people to read. So at any given time, you can come in and look and see how much capital does the mutual have? How much underwriting capital do we have? What are our assets held in the capital pool? What are they held in? You can look at our current liabilities with the current amount of active coverage that we're underwriting. You can see the claims that we've paid. You can see a detailed breakdown of the voting record on Dune. You can go and see, the summaries that we have on how past claims were decided. Pretty much everything that you would like to know, you can access without ever coming to us. And we have all of that information available, and all of that is because that data is held on chain and can be sourced from that on chain data. I think over time, this gives you insight onto what providers are fair, which providers are paying out. You can also look at the terms of service for any given cover product. Again, all of this is available through our SDK and available in the dApp itself. If you're looking at like a traditional insurer, they often make it difficult to get a hold of their policies. One, because they're competing with other insurers, but that information is somewhat proprietary and they don't want to share those terms too often. So as a user, you have to get a hold of somebody, you have to go through certain steps to actually get the terms, and then you have to go through it. And their insurance contracts tend to be very, very long. We're talking somewhere in the realm of hundreds of pages of text to go through. We try to keep our cover wording simple. I think the longest cover wording we have might be our crime policy, which is maybe 50 or so pages. But most other ones range somewhere between like 4 to 6 pages long. So they're meant to be shorter and digestible and more accessible for users. So I think over time, as people are building on chain, because things are on chain and have to be transparent by default, we'll see greater transparency in what kind of risks people are underwriting, what their capital holdings look like, and what kind of risks they're underwriting and if they have a track record of paying out. On the flip side, for capital efficiency, this comes to how a protocol is actually designed. So what we've seen in the past with some other insurers is that they split their capital pool. So they only have capital efficiency on one chain, not across multiple chains. One big difference with how we do things at Nexus is that capital pool stays on the Ethereum network. And so all of our underwriting capital is in one spot, which allows us to underwrite with up to 4.8 times leverage for the capital pool. So if we have $100 million in the capital pool, we could write up to $480 million of coverage because all of that capital is in the same place. And we can diversify risk enough where it's unlikely that any one business line goes down because we limit risk where any one policy that we're writing out or any one line of business, like Aave protocol cover, balance protocol cover, we limit that to a maximum of 20% of the assets in the capital pool. So if there's one hack, it doesn't bring down the entire capital pool, and at most it would bring down 20% of it. But even in that case, we don't see those levels too often unless we're in a really hot bear market or a really hot bull market. I'm sorry. Um, so capital efficiency is going to depend on design, but again, I think efficiency in general about bringing deals to market with speed is definitely something that we'll see with people building on chain and building in DeFi in the insurance space.
Thanks, Brave. A next question from Elliot along the same lines. Can we create products massively better than traditional insurance? I think yes. What do you think?
Yeah, I mean, I guess it depends when you're talking about what's different. The terms may be different, but largely some of the terms are going to be very similar over time. Again, this comes down to efficiency. So while it takes a while to receive a payout from a traditional insurer under a lot of different circumstances, we can improve the speed at which you can actually receive your claim payouts. There are things like parametric coverage that you can enable, and parametric is available in traditional markets as well. But if you put this on chain and you have all the right triggers, you can see a payout that's very, very fast. So I think in the areas of how fast claims get paid out, how fast claims get decided, a lot of those key areas for somebody that's actually buying coverage, buying insurance, we can improve the user experience quite a bit there. As far as like the legal terms, I don't know if those change too much with blockchain tech, but ultimately it's the efficiency and speed that we can really improve with on-chain coverage. So those are the areas where I see there being a massive benefit. And again, over time, if you can improve efficiency, you can also bring down the cost of coverage over time, which I think is the massive benefit that most people are looking for when they're looking at buying insurance or coverage.
Thanks, Brave. A last question from Elliot. Can better security remove the need for insurance altogether? I think this is one of those questions where it's really interesting to brainstorm about, but I feel like the open source nature of things really forbids us to go further when it comes to security. And you're quite an expert when it comes to security. So, what do you think, Brave?
No, my answer on this is no. You can never reduce risk to zero. So you can invest a lot in security. I'll use the Euler Finance V1 exploit as an example. So in 2023, Euler Finance was hacked for about $200 million. Euler was a very innovative lending protocol. Their V2 has been very successful. They've had a great relaunch and everything, and I'm really happy to see their V2 take off. But when they had their V1, lots of people were using it. It was very efficient. People really liked the user experience. They innovated on a lot of things. They had like, I don't know, 10 or 20 audits. They invested heavily in security and they still got exploited. So you can invest heavily in security. You can have a really high bug bounty program. But all it takes is one black hat, right? So you've got white hat hackers, people that are ethical hackers that report responsible disclosures if they find a vulnerability. And then you've got black hat hackers. They don't care about incentives. They don't care if you offer them $2 million to report a vulnerability because they know that they can make 200 million if they just exploit the protocol. We see that North Korean state-sponsored groups and everything, they have been responsible for some of the largest hacks we've seen, like the one that we saw with Bybit and some of the other exchanges and decentralized protocols we've seen, like the Ronin bridge hack. A lot of these have been perpetrated by these North Korean state-sponsored government organizations, like broadly we call them like Lazarus. So you can have better security, but it still doesn't remove that risk to zero. With better security over time, if we see the instance of exploits and losses go down, you can bring the pricing down. But I don't think that improved security is ever going to make anything airtight, because I think it's the case of like the old example of the Titanic, right? Um, they said that thing had 120 hulls and it was never going to sink, and then it hit an iceberg, and now it's at the bottom of the ocean. So you can think that your security is airtight until one day somebody finds a leak. And again, this is what insurance exists for in the first place. It's to hedge against and remove risk from the equation for different people, and then they pay some cost for that. So again, I don't think there's any scenario in life where you reduce risk to zero. But I guess that's my perspective as somebody who looks at risk all the time, and is looking at OPSEC risk and a wide variety of risks outside of what we even cover at Nexus.
Thanks, Brave. I also remembered a couple conversations with friends in DeFi who claimed that, at least for them, the need for insurance was non-existent because they were acting quite securely and they were only working with protocols that they trusted. But I think one interesting thing is the aspect of interoperability. Like a lot of projects share similar structures and code bases and libraries, and I think that's also another angle that people tend to forget about, and Nexus Mutual offers protection for. Thank you so much, Brave. It was amazing having you at the DeFi AMA. We have another question by Moss. I think it is best answered in a written way, because he's asking about a risk bucket calculation type of situation. So I'm going to leave it to you to answer on the forum. And this concludes our first series for the DeFi AMA. And let's hope that we continue with these episodes as we dive deeper with the first learning cohort. Thanks
All
again.
right.
Talk to you
Thanks,
soon.
Sam.
Bye.
Bye.